Hello and welcome to today's market briefing. Let's start with Wall Street. The three major indices finished flat yesterday. The Nasdaq closed at 25,980, the S&P 500 at 7,652, and the Dow at 53,417. No clear direction there. But pre-market futures are pointing to a higher open today. Nasdaq futures are up 0.32%, S&P futures up 0.23%, and Dow futures up 0.44%. Tech heavyweights are showing some early strength. Nvidia slipped 0.15% to $208.48. Tesla was down 0.11% at $348.95. QQQ and SPY were basically flat. One thing we're watching, the Bitcoin ETF is up 15.11% over the last 7 days, but we can't verify that move with external sources yet, so we're flagging it as unconfirmed and not treating it as a main theme today. Now let's look at the global macro picture. The 10-year Treasury yield is down to 4.66%, a drop of nearly 1% on the day. This continues the recent downward trend. Lower yields mean stronger demand for treasuries, which signals improving liquidity and risk appetite. That's supportive for equity valuations. The VIX is at 15.84, comfortably within the normal 15 to 25 range. Market sentiment is stable, no signs of panic. The dollar index is at 98.97, breaking below the 99 level and continuing to weaken. A softer dollar is generally positive for emerging market assets and commodities, but we need to watch the potential drag on dollar-denominated assets. The most significant move today is in oil. WTI crude dropped 3.42% to $82.08 a barrel. Brent fell even harder, down 4.83% to $87.67. That's a clear break below the recent trading range, and the medium-term trend has turned weaker. Spot gold slipped 0.37% to $4,684 an ounce, just consolidating at high levels. The safe haven bid is still there. So how do we read all this? The global market is in a mild risk-on mode. We have four signals aligning: stock futures moving higher, VIX staying low, treasury yields falling, and the dollar weakening. All of that points to improving risk appetite. But the sharp drop in oil is pulling down inflation expectations and creating selling pressure in the energy sector. That's why we call it mild risk on, not strong risk on. The conditions that would invalidate this view, if the VIX quickly spikes above 20, or if Nasdaq futures turn negative, then we flip to defensive mode immediately. Let's talk about the yuan. The onshore rate is at 6.7079, offshore at 6.7193. The currency remains firm. Onshore appreciated 0.22% in the last 24 hours, offshore up 0.06%. That tells us external demand for yuan assets is steady. The dollar index breaking below 99 combined with a stronger yuan helps ease capital outflow pressure and supports northbound flows. On the trade front, no new verified developments on tariffs or trade friction. We'll keep tracking export controls and tariff policy, especially any surprises from the Trump administration on tariff timing. If we get an unexpected negative headline, the currency and northbound flows could reverse quickly. For today's A-share open, we expect a flat start with higher probability. Supporting factors include a firm yuan, rising U.S. stock futures, and falling treasury yields. The headwinds are the oil crash hitting energy heavyweights, and the Chi-Next index already down 1% yesterday, which creates some short-term inertia. Putting it together, we expect the index to open flat and then diverge into a range-bound pattern. The invalidation conditions are, if northbound flows see net outflows exceeding 3 billion yuan in the first half hour, or if the offshore yuan weakens past 6.73, then the flat open call is off and we revise down to a lower open. For the Shanghai Composite, we expect range-bound trading today, with the trading band between 3,870 and 3,910. 3 reasons. First, the Treasury yield drop to 4.66% creates a liquidity supportive environment. The SSE 50 was up slightly yesterday, so large caps have some support. Second, the oil crash pressures energy names. PetroChina and Sinopec alone could drag the index by about 0.2 to 0.3 percentage points. Third, the firm yuan provides external support that offsets some of the negatives. If the index breaks below 3,857 on volume, then the range-bound view is invalidated and we need to reduce exposure. The Chi-Next index is likely to stay weak and range-bound, and we can't rule out a test of the 3,350 support level during the session. Chi-Next already fell 1% yesterday. Tech growth stocks are diverging internally. Nvidia's modest decline overnight has a neutral impact on the A-share computing chain. There's just no strong catalyst for upside. If Chi-Next reclaims 3,450, then the weak view is wrong. Sector-wise, the two most likely active areas today are airlines and high-dividend defensive names. The airline logic is straightforward. Oil down 3 to 4% in a single day directly improves fuel cost expectations. Historically, when oil drops more than 3% in a day, airlines beat the market about 70% of the time. The high-dividend defensive trade is driven by investors rotating into stable cash flow assets like utilities, water, and highway operators, especially when falling treasury yields make those yields relatively more attractive. Both calls are based on today's verifiable oil and bond data. The logic chain is complete. What to avoid: the energy complex, oil and gas exploration, oil field services, and coal. Brent down 4.83% has confirmed a break below its medium-term moving averages. The technical picture has turned from strong to weak. If futures keep sliding, A-share energy names will follow. Also watch the midstream and downstream petrochemical names for inventory loss risks. Don't catch the falling knife just because the drop looks big. On northbound flows, we think net inflows are more likely today. The signals are a stronger yuan combined with rising US futures. Northbound has become more sensitive to the exchange rate recently. USD/CNY below 6.71 onshore and the offshore rate stable below 6.72 create the currency conditions for inflows. The Treasury yield drop to 4.66% also narrows the US-China rate differential inversion, making A-share core assets more attractive. If northbound flows see net inflows exceeding 1.5 billion yuan in the first half hour, the full-day inflow picture gets more confirmation. If the yuan reverses course quickly, then the inflow call is invalid. On individual names, we have two watch candidates. NovaGold Resources, direction is range-bound with upward bias, 55% probability, time window 1 to 3 trading days. Gold mining has allocation value as a safe haven in a bull market, but this name is not core to the AI tech supply chain, and the 26% gain in 5 days is flagged as unverified. Watch for breakout confirmation. Invalidation, a break below the day's low or a significant deterioration in risk appetite. Position discipline, observe only, do not chase. Second, Bitmine Immersion Technologies, also range-bound with upward bias, 55% probability, 1 to 3 day window. Immersion cooling technology has conceptual ties to data center heat management and the AI compute supply chain. But the company is small, the 32% 5-day gain is unverified, and order authenticity is questionable. Invalidation, a break below the day's low or negative fundamental news. Position discipline, wait for order verification before acting. Now for existing positions. The indium phosphide substrate supplier, direction is relatively resilient, 58% probability, 1 to 5 day window. Indium phosphide substrates are core materials for AI optical modules. The downstream demand logic is intact. The stock is down 6.6% on the month but has zero catch-up progress, so it's in an accumulation phase. Hold and wait for the catch-up trade. Invalidation, a break below the 200-day moving average or the catch-up thesis is disproven. Position discipline, hold, do not add. The data center transformer name, downside risk dominates, 65% probability, 1 to 5 day window. Down 15.7% on the month with no signs of catch-up, the technical picture has broken down. The demand logic for data center transformers hasn't changed, but when the trend deteriorates, we respect the price action. Invalidation, reclaiming key moving averages with volume confirmation of a reversal. Position discipline, exit the position. The silicon photonics CPO name, relatively resilient, 58% probability, 1 to 5 day window. CPO is a core AI compute track. Catch-up progress is 32.7%, relatively strong, but the stock is below the 200-day moving average. Watch for a breakout signal. Invalidation, a break below the 200-day or the catch-up thesis is broken. Position discipline, hold, and consider adding only after reclaiming the 200-day. The high-speed laser name, relatively resilient, 58% probability, 1 to 5 day window. Demand is strong, but catch-up progress is only 5.4%, and heavy insider selling is a warning sign. Hold but set a stop loss. Invalidation, a break below the 200-day or failed validation of major customer orders. Position discipline, hold with a stop below $260. The CoWS packaging and testing name, range-bound watch, 52% probability, 1 to 5 day window. Catch-up progress is at 100%, up 24.46% on the month. Expectations are fully reflected. We suggest taking partial profits. Invalidation, a high volume break below recent support. Position discipline, take profit on half the position, trail the stop on the rest. The risk avoidance name, the indium phosphide substrate company, downside risk dominates, 60% probability. Catch-up progress at 100% and elevated geopolitical risk. We suggest taking profits and exiting. Invalidation, geopolitical risk clears and the stock holds key moving averages. Position discipline, exit fully, don't chase. We have no high-confidence new weak market candidates today, so no forced recommendations. Let's wrap up with the core takeaway. Treasury yields falling, dollar weakening, yuan firm. The oil crash pressures energy but benefits airlines and defensives. A shares will likely diverge in a range-bound session, look for structural opportunities. Today's probability assessment, up 30%, range-bound 45%, down 25%. That's all for today's briefing. Thanks for watching, and we'll see you next time.